Welcome to the All Financial Hour podcast with Steve All.
At the beginning of the year, we heard predictions that the Fed would cut interest rates 6 times in 2024. We're almost halfway through the year, and it hasn't happened yet. So the question is, what now? Economist Mohamed El-Erian, he says this on CNBC.
I have felt for a while inflation is going to prove sticky, that the last mile is really complicated, and that we're not sure what the Fed's reaction function is. If the Fed remains data dependent, then the Fed will be more hawkish than it needs to be. So I am hoping that the Fed will be less data dependent. I am hoping that they will look forward, realize that the economy is weakening, and deliver on 2 cuts starting as early as July. That is what I'm hoping.
So what does he mean when he says, higher interest rates for longer? What does that mean to a retirement plan? And is it good or bad, Steve?
Well, what we're talking about is a lot of times when interest rates go up, they go up a little bit slower. This year, they got so far behind on the inflation because they waited so long to start. It jumped almost straight up. But in the past, when interest rates start to come down, they've come down very quickly. And that's what a lot of people are looking for, is that high rate and then all of a sudden go to lower rates very quickly. And in this case here, it's that happened. He said, like I said, they were going to do it 6 times. They haven't done it once yet. We got good news earlier last month when they said that we're not going to raise rates because there was still a chance that we could raise rates to fight that inflationary figure. So good or bad depends on where you're at. It's bad if you're younger, buying houses, buying cars. Those interest rates are higher right now. So you are going to pay more for a home. You are going to pay more for a car. Credit cards are already really high, so we want to avoid those anyway. But debt, we start to look at it. And then we go to the opposite side of the fence. For those that are retired, most people that are retired, yes, they might still have a house payment, but they're currently paying the latter years of that payment, which is what? Predominantly principal. Those latter years, that principal is down, and those are at lower rates. Cars could become a part of the process. So those are the things that we have to look at because we have to replace those. But in most cases, those aren't the major things that are going on with us. But what do people like? People like the fact that you can get a CD at a rate higher than 0.000, you put the number behind it, not very high rates. Now, CDs have never kept up with inflation, but we feel better when we're getting those rates. Savings accounts are better. The insurance companies, there's more interest out there so that when they start looking at income riders, that income rider is where you give the insurance company the money. I prefer it on a deferred basis, not a single premium immediate annuity when I'm just handing them the check. And if I prematurely pass, they get to keep it. But there's more money out there. So in a lot of cases, we can take an old annuity contract that you have not turned the income on. And we can actually run that to find out, could we increase the amount of income that you could get with that exact same annuity with a new annuity? Now, if we did something like that, you would have a longer surrender period. So there are pluses and minuses when it comes to things like that. So we could look at it and say, could we be able to replace that? And I think that's the things that we have to look at when we're starting to look. John and Nancy had come to talk to me. They had an annuity that they hadn't turned the income on. But the annuity with the income that they were looking at, their expenses weren't quite as high as they thought they were going to be. And if they turned on the income, they were going to have a lot more income than what they currently needed. So they said, what are options around this? So if you're in that same case and you have an annuity that you haven't turned the income on, we could look at it and say, could we replace a part of the annuity so that the income is more in line with what your current needs are? And then reinvest the balance of the account. So those are the things that we would look at for yourself. So if you're looking for that income that you cannot outlive, or if you've got an annuity that you haven't turned on the income rider yet, give us a call. Let's look and see, could we replace that and get you more income than what you could currently get?
I read an article recently about a woman who inherited $741,000 from her aunt. And she was to share it, of course, with her 2 kids, but she had no idea what to do with the money for her kids. So she put it in a traditional savings account with a 0.01 interest instead of investing it. So by the time she realized she made this mistake, it was too late because of the way the inheritance was structured. So many of our listeners, they might be going through something similar, or they might, in the future inherit a large sum of money. What are some of the options that we should consider if this happens?
Well, the thing that I heard within the article is there was not a lot of stipulations. So to get the money to the children, they had to go through guardianship. See, if I have my own legal documents, and my legal documents say my wife's the heir, my children are the heir, or something else, they'll follow those legal documents. But if you don't have legal documents, the state has a way to distribute your assets. Probably not going to be in the route in which you wanted it to. Mm-hmm. So a guardian had to be brought in because the kids were underage. Well, guess what happened? The kids got older. They never switched the guardian.
Oh, no.
So therefore, she then came back and she could not change it. It would have to be done by the kids. And since the kids didn't really know they had it, it just made a difficult situation. And that's why we look at it for ourselves. We're not lawyers. I don't practice law or do anything like that. But when we have clients that come in, the biggest surprise for me in this industry was the lack of legal documents. No wills, no trust, power of attorneys, none of that stuff. It was a really big surprise for me. So that's when we bring in an outside firm that can help us get what I call I love you wills and trusts. That's kind of like I love my wife, and anything happens to me, she gets it. And I love my children equally. And if anything happens to the 2 of us, it goes to them. We can help people get simple wills and trusts. We do that for our clients. But if you're out there and you don't have those documents, give us a call. We'd be happy to refer you to a lawyer that can assist you, because the only promise I can make you, you do not want to go with what the state might have in mind for you, because I can promise you it's probably not what you have in mind for your own estate. Give us a call now, because I believe that legal documents are the things that almost everybody needs to have. Give us a call now. We'll refer you to an attorney.
When you retire, you might have a house here. You might have another house maybe in a warmer climate. And then you have to be careful to spend just the right amount of time in the state where you want to file your taxes. So the state of New York went after one man saying that he owed them tax revenue because he had an apartment in New York and he didn't spend enough time in Texas. But the man won the case because he had moved his dog to Dallas. So apparently where your dog lives is officially your state of residence. Hey, kind of a smart plan here. How does that work with tax planning, Steve?
I haven't seen that one in a lot of the tax legislature that I've had to look at, but it's the 2 big questions that really get kind of asked when it comes to that. Where you choose to live at the moment is considered where you're a resident, but you're domiciled at where you call your permanent home base. So therefore, there are rules around those 2 things, like the state of Missouri. It's like 183 days lived in the state of Missouri. Mm-hmm. So you can have a place down in Florida. And if you live 183 days in Florida, you can file from there. They're going to want a portion of your Missouri income, but you would be able to file for a part of it. And the only thing of it is a lot of the states that people are leaving, that a lot of those states are doing exactly what happened here in New York. Hey, you're leaving our state and you're leaving that tax revenue off the table. California's doing it. Missouri's looking at a couple things to try to claw back some of that money that they're given. And that's what I believe is the greatest risk that we have out there that nobody ever talks about. That's called legislative risk. What is Congress going to do? What are they going to change? The rules around the Roth IRA have changed 4 times since they've been in existence, and that was from the late 90s. So those are the things that we have to worry about, is what is Congress going to do and change the laws as we currently see them. Remember when we used to have the stretch IRA, you could stretch it over a lifetime. Now they've got it. It has to be taken out in 10 years. Legislative risk is the biggest risk that you can take. And I believe that reducing or eliminating taxes in retirement is the greatest thing you can do for the success of your retirement. If you have more than $500,000 in investable assets, please give us a call now. Let's talk about tax planning and see how we might be able to set you up and pay taxes at a rate that you're willing to pay versus what Congress is going to decide. Because remember, in 2026, the Trump tax cuts go away unless Congress makes it permanent. Give us a call now. Ask for the tax planning.
Now, Steve, you've told us time and time again about the benefits of waiting until age 70 to claim Social Security. You know, it's that we're going to be rewarded up to 8% more in benefits each year that we delay past our full retirement age. But can putting off until 70 come with any serious cost? You know, when does it make sense to wait that long?
That's a different question than you normally ask, because that is my answer: delay, 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 as long as you possibly can. But there are situations where we would look at it. And I'd say the biggest difference is when we start to look at when you should take Social Security, a lot of it is around, are you single or are you married? Are you the higher earner or the lower earner if you're a married couple? And what's your current income? Because all those things come into factors when we start to look at Social Security and when we can actually take Social Security. So Larry and Sherry had come into the office. Now, Sherry had not worked outside the home for most of her life. Larry was the higher earner. So 2 years younger also. So they looked at it and we came along and said, well, let's look at taking Sherry's at 62. And it was like, well, that would be a lower amount. And it would say, yes. But because of the spousal side of it, then you have it on the spousal side of it that they have the availability that when Larry passes away, a spouse or benefit will be the larger of the two. The other thing that we have to look at if you're thinking about taking Social Security, income. If you make more than about $22,000 to $23,000, there's what we call the annual earnings test. You have to look at that, because if you make more than that and you're under full retirement age, about $1 of every $2 you make in Social Security could be held as what they call a penalty at that time. Now, you'd get it back once you hit full retirement age, but it could reduce the amount of Social Security that you get again. So we have to look at that. Health issues. If you're single and you have health issues, that break even for a single person is about age 80. The longer you live past age 80, the more advantageous it is for you to delay. As a married couple, we have to look at that same age. If one of the two of you all will live past age 80, the larger earner should wait as long as possible. And as I said before, the lower earner, you could turn it on when it comes to there. As you can sit here and say, there are thousands of ways that you can take Social Security. The best thing when we start to look at Social Security is to have somebody come in, bring in your Social Security estimates. We're going to do a full analysis because I have to look at what you have to give us the availability to say you might want to delay taking Social Security. So I have to do a full analysis to get a true optimization of your Social Security and say, when is the optimum time to take it? Because a lot of people say, I just want to maximize it. And I say, well, both of you wait till 70 and live to 95. That'll be the max that you can get. But optimization, I believe, is much more important. We might take one early, let the other one delay as long as we can. Spend down some of those assets if we have them in IRAs. Why? Because now when we hit that age 73, depending on how old you are, it could still been 70 and a half. You're taking those required minimum distributions. Let's spend down some of those assets so that we don't have as large of requirement distributions in the future. Give us a call now. Ask for the Social Security analysis. A reminder, I can't do it in a vacuum. I have to look at all of your stuff to find out when is the optimum time for you and your spouse to take Social Security.
Steve, are you a big fan of Tom Hanks?
Love Tom Hanks. You know, everywhere from Big. Big was probably my favorite one. Yes. You know, watching him, dance on that piano.
Of course.
And doing that and, being a kid and then having to grow up. God, how many times do you just wish you could just be a kid again?
Oh my gosh, all the time. I say that.
I want to be big, but then when you get there, it's like,
no, I want to go back.
I loved it when his little buddy came along and said, "You used to be fun," and and it's like, yeah, we have to grow up and become responsible.
Yeah, exactly.
So that's probably one of my favorite Tom Hanks.
Yeah, Tom Hanks, love him. I've met him. He's easily one of the coolest guys I've ever met. Super funny and down to earth, which is why when I heard about his response here about, maybe something that he regrets not learning earlier in life, I just found it's very something I think everyone can identify with. Listen to this.
I wish I had known that this too shall pass. You feel bad right now? You feel pissed off? You feel angry?
Yes,
this too shall pass.
Oh, great.
You feel great? You feel like you know all the answers? You feel like that everybody finally gets you, and there you are.
Yeah.
This too shall pass. Ooh, good. Time is your ally, and if nothing else, just wait.
Just wait.
Just wait it out.
And those other voices that you're hearing, he kind of did a roundtable with a couple other actors, Robert De Niro, Jamie Foxx, and Adam Sandler. And I love that he says, time is your ally. Just wait it out. And that's great for a lot of things, but you can't wait out retirement planning, right?
No, I don't think you can. As somebody put it to me, the best time to start investing was yesterday. And the second best time is today. And I hear one of the biggest regrets from our clients, I wish I would have started earlier. The power of compound interest in starting early in the planning process is to me is one of the greatest. And then I'll go to that Tom Hanks quote. A buddy of mine put it, "This too shall pass." It's a lot better than "this too will last." Because some of those bad times, I'm glad they are going to pass. So we'll look at it from there. But in retirement planning, I think the biggest thing that we had, Mike and Rachel came to one of our events. And I come around. It's not a big sales pitch. Would you like to come in and sit down and talk with us? We like the things that you said, but we're about 5 to 10 years out. We'll give you a call in about 5 to 10 years. And I just looked at him. I said, now is the time to come in. So if you're looking at when should I come in to plan, I think now is the time to come into plan, because we'll do the analysis of where you're currently at within your savings for retirement. And if you're one of those people that we see quite a bit of, that are about 85 to 90% of your assets are held in your IRAs and 401ks, it might be advantageous to look at how you're saving for retirement. You're doing a great job of doing it, but maybe we could shift the way we're saving. Because if we don't, everything's going to come out of that taxable bucket. Could we look at it and slow down the max amount that you're putting into your IRAs and 401ks? Just put enough in to get the match, and then use other vehicles, Roths, Roth contributions to 401ks if you have it or the availability. We do shift money into the indexed universal life policies for somebody. Why would we do that? Well, that tax contract says that I can save after tax money. It grows tax deferred, and if I pull it out properly, it's non-taxable income. And we think that's a great vehicle to have in addition to your Roth accounts. Why? Your Roth accounts are controlled by Congress. They get to change the rules. Life insurance policies are contracts. The government can say we can't do this anymore, but they can't get rid of the old policies. So if you're saving for retirement, you're doing the things that you're supposed to be doing, give us a call now. Let's sit down and look at where you're at in the planning process. If you're over 59 and a half and 5 to 10 years out from retirement, give us a call. Let's look at that comprehensive retirement plan to see if we might be able to shift the way that you're saving for retirement.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group LLC.
This radio show is intended for information purposes only.